Welcome to Talk Tickers. Today, we are diving straight into the JVO Incorporated first quarter 2025 earnings call. Our mission, as always, is to cut through the noise, get you the essential insights, the stuff that might give you an edge. So let's jump right in. What were the big headline numbers?
Okay, so for Q1 2025, JVO reported $29 million in revenue. But the key thing here is that most of that came from just 2 months of operations.
2 months.
Yeah, from their new JVO North Dakota facility they just acquired. We also saw year-over-year growth in their RNG revenue, that's renewable natural gas, came in at $5.7 million.
Okay, 2 months driving most of the revenue. That North Dakota deal sounds, well, pretty significant then. Let's dig into the segment performance a bit more. How did North Dakota actually do on its own?
Right. So JVO North Dakota, just for February and March, mind you, generated $500,000 in income from operations and $1.8 million in adjusted EBITDA. Again, just 2 months.
Okay. And the RNG side?
JVO RNG also looked pretty solid. $1.1 million income from operations and $2.7 million in adjusted EBITDA for the quarter.
So some definite bright spots there. But what about the overall company picture? Was it profitable?
Well, that's where it gets a bit different. On a consolidated basis, company-wide, they actually had a loss from operations of $20.1 million. And the non-GAAP adjusted EBITDA loss was $15.4 million.
Okay, so still in the red overall. Yeah. But they expect that to improve.
Yeah, they were pretty clear they anticipate, continued improvement in adjusted EBITDA through the rest of the year.
Right, likely banking on places like North Dakota. Let's focus there. Why is that acquisition seen as such a game changer for them?
It really is central to their plan to hit EBITDA positivity this year. The plan itself is pretty big, 67 million gallons per year ethanol capacity. But the really critical part, it has an operational carbon sequestration facility.
Carbon sequestration. Okay, so capturing CO2. For listeners, that's basically taking carbon dioxide out of the process and storing it, right? How does that help the bottom line?
Exactly. And because they have that capability, the IRS gave them approval to apply for the 45Z tax credit. This credit is a big deal. They expect it to start benefiting the P&L next quarter.
And is that common, having that sequestration set up?
Well, according to JVO, it's actually quite rare right now. They believe only about 2 ethanol plants in the whole country are set up to benefit from 45Z at the moment. And, they own one of them.
Only 2. Okay, that definitely sounds like a competitive advantage. What makes their ethanol special then? Is it just the sequestration?
It's tied to the carbon intensity score, or CI score. Lower is better. Their score for the ethanol at JVO North Dakota is around 20, which is quite low. That low score helps them maximize those 45Z credits. Plus, the site itself has room to grow, and they're talking about more ethanol, more corn supply, and adding an alcohol-to-jet plant. ATJ.
ATJ, sustainable aviation fuel. We hear a lot about that. And North Dakota is the spot for it. Why there specifically?
Seems like it. They see North Dakota as, really favorable. You've got the corn right there, plenty of it. You've got land, you've got the existing carbon sequestration that's huge. And of course, the existing ethanol plant is already running well. So yeah, plans are already moving for a 30 million gallon per year ATJ plant there. They're calling it ATJ 30.
Okay, ATJ 30. Are they using existing plans for that?
They are. They're leveraging the design work from their bigger ATJ 60 project concept to speed things up for this ATJ 30.
Smart. Makes sense. And how are they planning to build it? Anything different there?
Yeah, they mentioned focusing on modular construction. The idea is, build sections in a factory, bring them to the site, should reduce risk, maybe lower labor costs, get it done faster, hopefully.
Okay. And beyond just making fuel, you mentioned carbon earlier, are they selling that benefit?
They are. They're making progress, selling what they call voluntary carbon abatement. Essentially, companies downstream buy the credit for the carbon JVO, avoids emitting or sequesters. And it's interesting, they said between fuel contracts and these carbon deals, about half the potential output of that future ATJ plant in North Dakota is already spoken for.
Half already. Wow. Okay. So there's real demand. What about the bigger ATJ project, the ATJ 60 in South Dakota? Is that still happening?
They're still pursuing the Department of Energy loan guarantee for it, the traditional route. But you get the sense the focus, maybe the immediate focus, has shifted a bit. They really seem to think North Dakota is the ideal place to deploy ATJ capacity relatively quickly. Their big picture view is that alcohol to jet is just the most economical way to add new jet fuel capacity in the U.S. right now.
That's a bold statement. How big do they think this market could be?
Their analysis suggests the U.S. might need something like over 60 million gallon ATJ plants in the next decade. So yeah, they see a massive opportunity.
Okay. Let's shift back slightly to the financials. The RNG revenue was up, you said. What drove that?
Right. It was mainly driven by generating more LCFS credits, low carbon fuel standard credits. Basically, they improved the carbon score of their RNG, so they earned more valuable credits. That helped offset the fact that RN prices, those are the renewable fuel blending credits, were actually lower.
So even in the established RNG business, that low carbon angle is paying off.
Exactly. And that positive income and EBITDA from North Dakota in just 2 months. The company sees that as real momentum. The overall losses, the ones in the consolidated numbers, they attribute mostly to R&D spending, project development costs.
Especially for ATJ, I imagine.
Yeah, particularly ATJ development, plus other operating costs. So investments for the future, basically.
Right. Investments they expect to pay off soon with those EBITDA improvements you mentioned.
Precisely. They're linking future EBITDA gains directly to monetizing 45Z credits, getting more value from RNG with its new, even lower CI score they mentioned, a negative 339 score.
Wow. Negative 339.
Yeah, really low. And just continued good performance from North Dakota. Operationally, they said the integration there is going smoothly. They're looking at expansion options, engineering the ATJ plant.
It really does sound like North Dakota hit the ground running.
Yeah.
What were the actual production numbers in those first 2 months?
Pretty impressive. Over 11 million gallons of low-carbon ethanol, over 40,000 tons of high-protein animal feed that's a co-product, and 3 million pounds of corn oil, all from under 4 million bushels of corn.
What kind of yield is that on the ethanol?
Comes out to about 2.9 gallons per bushel. Pretty efficient.
And the carbon capture numbers?
They captured and stored 29,000 metric tons of CO2 at the North Dakota site in Feb and March. And based on their CI score of 21, they calculate that avoided about 7,000 metric tons of emissions compared to, say, gasoline. Add to that, JVO RNG produced about 80,000 MMBEDIS of renewable natural gas last quarter.
So across the board, the total carbon abatement
exceeded 100,000 metric tons last quarter across all their operations.
Okay, so they're definitely walking the walk on sustainability. How's the commercial side developing? Are they actually selling these carbon benefits yet?
They're getting there. Negotiations are happening right now for the first sales of the 45Z tax credits for both North Dakota ethanol and the RNG. They mentioned getting the necessary IRS forms, Form 637 approvals. You need those to generate the credits. And they're also pushing to sell more of what they call durable carbon dioxide removal credits, or CDRs, from the sequestration in North Dakota.
So multiple angles on monetizing low carbon.
Seems to be the strategy. They even signed an offtake deal with a company called Future Energy Global. It's for Scope 1 and Scope 3 emissions credits tied to 10 million gallons a year of future ATJ fuel. And importantly, they stress the value of these carbon attributes is separate from the fuel price itself and separate from other tax credits like 45Z.
That's interesting, layering different value streams. And are they planning to own all these plants themselves?
Doesn't sound like it. They're actively looking for partners globally. The plan seems to be develop the sites, license their ATJ tech and business model, maybe take a strategic stake, but not necessarily own 100% everywhere.
Okay, that makes sense for scaling.
Yeah.
Now, policy is obviously huge here. What was the feeling on the regulatory front from the call?
Generally optimistic, I'd say. They seem pretty hopeful about 45Z getting extended beyond its current timeline, maybe to 2031. And they're really keen on the potential removal of indirect land use change from the carbon intensity calculations. That's a big factor for corn ethanol.
Right. That's always been a controversial part of CI scores.
Exactly. They also like seeing a specific pathway created for dairy RNG within 45Z. Their estimate, 45Z credits are worth roughly 2 cents per CI point below the threshold. So lower scores mean real money.
Any potential clouds on the horizon, policy-wise?
They did mention the possibility that the transferability of tax credits might get repealed after 2027. Their take was that might actually push more direct investment into plants, which could suit them. They also noted strong support in Congress for tax credits going to producers, like them, rather than just fuel blenders. But overall, yeah, removing indirect land use was seen as a major positive.
Okay, supportive environment overall, it seems. Now, you mentioned they shifted focus a bit from ATJ 60 to ATJ 30. Why that pivot?
Yeah, they've pulled back spending on the big ATJ 60 project for now, reallocating resources to ATJ 30 in North Dakota. They also plan to refinance their RNG plant, which should free up some cash. The thinking is that ATJ 30 timeline could actually be the same or maybe even faster than the ATJ 60.
Because it's smaller.
Modular.
Exactly.
Yeah.
Smaller, modular, using designs they already have. It should also be cheaper to build than the bigger plant.
And apparently it's already getting a lot of interest. Remember how we said over half the capacity is sort of spoken for?
Right, under different contracts than the big DOE-backed one.
Yeah, different structures. Suggests strong market pull for that smaller, quicker plant.
Makes sense. And the value of these carbon credits they hope to sell, like those CDRs or the ones in the future Energy Global deal, is there a real market there?
It's definitely growing. The market for these durable carbon removals, sometimes called BECCS CDRs, bioenergy with carbon capture and storage, is getting more attention. And the value they implied for those Scope 1 and 3 credits in the FEG deal, significantly higher than current LCFS prices, like potentially hundreds of dollars per ton.
Hundreds per ton. Okay, that's a different league than typical carbon markets.
It is. And JVO wants to access that market directly, capture that higher value themselves if they can.
So looking ahead, what's the grand vision here? What do they lay out?
Well, definitely expansion potential in North Dakota, maybe more ethanol production, which means more carbon captured. The broader strategy seems to be deploying multiple ATJ-30 plants, maybe in different places, using that modular factory-built approach. But they also see room for more ATJ-60s down the line, plus licensing their tech they mentioned having over 100 patents, so multiple paths to growth.
Definitely sounds like they're positioning themselves right at that intersection of renewables and carbon management. A lot going on. All right. That brings us to our favorite part, the This Is Not Financial Advice segment. Based on everything we've just unpacked from the JVO call, what's the bold, maybe slightly outrageous, but plausible trade idea you've cooked up for us?
Okay, all right. So, standard disclaimer first. Obviously not advice, just thinking out loud for fun here. Given how JVO seems really well positioned for 45Z, maybe better than most, and this potentially high-value voluntary carbon market they're tapping into, you could argue the market isn't fully appreciating that near-term cash flow potential. So a straight long on JVO might seem logical, right? Betting on those catalysts hitting the bottom line sooner than expected.
Okay, that's the straightforward part. Where's the outrageous twist?
Right. Here's the pairing for the more adventurous. Consider pairing that long JVO position with a short position on let's say, a large traditional agricultural commodity producer, one that's maybe heavily reliant on older farming methods, hasn't really articulated a clear plan for, low carbon agriculture or adapting to feedstock demand from places like JVO.
Okay. Shorting big agriculture. Why?
Well, the thesis is this. As policies like 45Z push demand for low CI feedstocks, and as companies like JVO start demanding, maybe even paying a premium for, verifiably sustainable corn, those traditional producers who don't adapt might face higher costs, maybe shrinking demand for their standard product, or even new regulations forcing changes. It's basically a bet that agriculture and energy are getting tightly linked through carbon. You're long the company enabling the transition, JVO, and short a company potentially lagging behind in that transition. It's a longer-term thematic play for sure, betting on the sustainable disruptor against the incumbent potentially facing a changing landscape. How's that for outrageous but plausible?
That is definitely thought-provoking. Pitting new energy against old agriculture via carbon intensity. I like it. But remember, everyone, just an idea for discussion. Do your own research, talk to a professional. Absolutely not financial advice. So what are your big takeaways from JVO's plans? We'd love to hear what you think. Feel free to join the conversation.
Yeah, definitely curious to hear other perspectives on this one.
Great stuff. Okay, be sure to tune in next time for another Talk Tickers deep dive into the earnings calls that matter.